All right, well, Michael Monotskine in here. So today we're going to focus on underwriting and deal analysis. Whether we have the guests have a deals to underwrite or we'll just underwrite our own deals. Akash, you had a quick question, which is where is a good place to find out if we have deals that we are opportunities, creative finance opportunities that you can get access to. So first and foremost, I would say the wealth through real estate school community. That is the goal, is to get more of my wholesaler friends in there submitting their deals. So we'll get that going in the very, very, very near future. I'll reach out to them and they'll definitely submit their deals. Otherwise, I will also drop a form in the Wealth of Real Estate community where you can sign up and then we can send you deals as well. We have it pretty well integrated within our CRM so that we can, once we get something, let's just say we decide we don't want to buy it for whatever reason, at least then you have an opportunity to see it. And maybe we've even done some of the groundwork at that point on the deal. So I will have all of that in the Wealth of Real Estate school community, absolutely free, which is awesome. So let's see. Do you have any deals? Does anyone have any deals they'd like me to underwrite, or should I just underwrite deals that my team and I have?
Yeah, you can start. I mean, I did a couple of underwriting. I did underwrite a couple of deals with John Her on
Mhm.
the creative camp side, but they're not really cash flowing, so moved on. So I don't have it currently. I did find one. It's like a glamping cabin. If let me just find it. I'll share it with you. It's like super
That will
cheap.
be hard to underwrite unless
Yeah,
you have the short-term rental income projections or you have the profit and loss historically. Because there's not a lot of comps for something like that.
exactly, exactly. It was just something so cheap that was available. So, I'm having a look. I've asked the information from the realtor. They did run on Airbnb, but
Mhm.
I don't have anything in terms of their expense statement. They did send the information on the gross revenues or
Okay.
gross earnings, but nothing on the expense side. The only thing that I was even looking at it is it comes with 5 acres of land. That's about it. But
All right.
ignore it.
So for YouTube, I will not be able to show the property, but let me check it out. I
Yeah,
mean, let's go higher level, right?
sure.
Let's screw underwriting. Let's dive into you and your business. Is that cool with you? Do you want to do
Yeah.
something like that? All right, awesome. I love doing this. And this is what my mentors do for me quite frequently. And I'm pretty inspired based off how, Pace Morby, my most direct mentor, invited me out to spend a whole day with him yesterday to speak on the largest stage I've been on, over 300 people. I also spoke in their smaller group VIP event with Tony Robinson. They're all they
Wow.
do is short-term rentals. And we got Pace doing creative finance. We've got the Robinsons doing short-term rentals, and then we have me buying multi-million-dollar short-term rentals. Zero money out of pocket, all creatively financed. But the main idea here is my mentors, they help me by not just showing me how to do things, but also asking me why am I doing things. So let's start there. What is your overall goal for real estate investing? Why are you even doing this in the first place? Because you're obviously working hard.
Yeah.
This is a second job, we'll say. Like, what is the purpose behind all that for you?
I think there are three goals for me. I think the first goal in the short term is absolutely to save tax. Me and
Okay.
my wife, we both are in W-2 jobs. We are in California, in Bay Area. We pay ve- a lot
Over
of
28%, we'll say.
yeah,
You're in the top. Yeah, you're
yeah,
you're paying a lot of taxes.
yeah. So I'm paying a lot of taxes. So
And let
that
me clarify, for California, as a Californian, you will be able to potentially offset your federal income
federal
tax, but
taxes.
not state, right? For
I
anyone
know.
who doesn't know that, you'll be able to offset your federal income tax. California doesn't give a crap about your deductions. You will pay your state taxes.
Exactly, exactly.
State taxes.
Even the federal is super high. So that's my first goal. The second goal is that I'm not a big proponent of investing in the share market. I've
Mhm.
burned my fingers in the past, and real estate is something that I understand. My wife understands. We have a few long-term rentals. We have one short-term rental in Joshua Tree which hasn't done well.
Mhm.
Again, we don't manage it. It's all passively managed through property managers and so on. But I think we bought that rental as a second home more than a short-term rental.
So you
Okay.
did like the 10%. You mean that's what you that's like,
Yes.
okay. So you did the 10% second home loan to get
Correct.
into it, which is nice because you put less money down and didn't
Correct.
have to live in it. But
Correct.
it sounds like it's not satisfying what you need because it's losing money each month. Is that
It
correct?
is.
And on
Yes.
top of that, you're only going to get the tax benefits, right, on your active income
Yeah.
if you or your wife are a real estate professional, which
Yes.
I'm assuming you can't qualify for.
No,
And
we
you're not
cannot.
doing the short-term rental tax loophole because
Yes.
someone else is managing your asset.
Yes.
You don't even get the tax benefits.
No.
Okay,
No.
got it.
So, and then the third reason is twofolds, right? I have a 7-year-old daughter, and I'm looking at this as retirement, right? So, both for my daughter's education, higher education, for her to be set up for life, and for our retirement, right? We work really hard. We work, 12-hour days easily in our W-2 jobs. But my goal is that, similar to you, I want to find uh you know start to invest time in short term rentals, and that's why I'm not in a hurry. So I want to invest something into something by August, September, so
Mhm.
that I'm able to manage it for the 6 months before I move it into a property manager or potentially a long term rental, right? um Even I don't necessarily want it to be, I know that there is like a 20% goal of, getting returns. I don't have that goal, right? Even for
Right,
me, even if it is a single digit cash flow positive sort of a property, I'm fine with it because
right.
I am looking at it from a long term horizon standpoint.
Yeah,
I
so
just
let
don't
me
want to put out of pocket money.
Right. Let me try to summarize that, right? Because you're a unique type of buyer, but you're not overly unique because I connect with people like you every single day. And actually, a lot of them are my lenders and partners on various deals because they have more money than time. And for you, what you're primarily looking for is tax benefits.
Yeah.
So that's like your number one thing is depreciation. So honestly, the bigger the loan, the more expensive the property, the better. And the
Yeah.
less money you put in to get that makes it even better on top of that.
Exactly.
You have an advantage because you don't need it to cash flow. You just want it to pay for itself. You don't
Yes.
want another asset that is losing money each month.
Yes.
As obviously in the long term, it'll probably become positive, if
Yeah.
it's not too far away. But in the short term, you still don't want to lose money at all. I get that. The deal you sent me, don't even look at something like that. It's not worth your time. You only
I
have
know.
so much time. Buying a $19,000 property, that's a little thing in Texas, is not going to solve anything for you,
Yeah.
except for maybe you can write off your closing costs. And there's better ways to do that, for sure.
Yeah.
So I will highlight that. Like that already, what the property we're talking about, like the multi-million dollar short-term rental I have, that is in more alignment with the kind of property that you're looking for if
Yeah.
your main goal is tax write-offs. This
Yep.
Florida property you just sent me, which unfortunately I cannot screen share because thanks YouTube, um, is something that could work for you.
Yeah.
We can dive into it, but is this I assume this is going to have to be a short. So let me ask you this. You're doing short-term rental just so you can qualify for the short-term rental tax loophole. So you will have to self-manage it. How do you
Yes.
anticipate being able to do you feel ready to be able to self-manage a luxury $1 million+ property? Not to
So
discourage you, but that's
yeah.
one way you get the tax benefits.
Yeah. So I think I'm going through the training with the host campers. I'm
Right,
understanding how it happens. Also, that's why I'm looking at it in the second half of the year, and not buying it in the first half of the year. So minimal time. I'm also trying to figure out that I get a turnkey property where furniture, etc., is already there, and I have minimal work to
right.
set it up. I'm
You
also
prefer buying someone else's B&B,
exactly.
ideally, right,
Possibly, yes. I'm also looking at markets where, there is natural flow of tourism, tourists coming in, so I don't have to, do too many ads, social media, stuff like that. What I'm thinking about is also figuring out, like, hiring like a VA or something, to help me with a little bit of communication so that I can still qualify.
right.
Um,
Have you
and
talked to your CPA about this whole plan in general, in
yes,
regards to will they, with a VA and all that, they said, we'll
yeah,
still, because honestly, you can write whatever you want in your tax return. It only matters when you get audited, right? Because,
Yes.
people do a lot of crazy things in their tax returns. I
Yes.
think you have a case if you're self-managing it, you just have support of a VA. If you're just the one who's primarily managing it,
Yes.
you set up your automations for communication and tenant move in and all that. That's what you're learning, or
Yes.
that's what you've been learning.
Yes.
That's a, I think you actually have a good plan. I think a lot of the times people have a plan like this and it doesn't really fit in for what they're trying to do. But if your goal is to save taxes, you don't want to really invest in stocks, because what you could do to save taxes, the most obvious way, is to invest into your tax advantage retirement accounts,
Yeah.
401ks, IRAs. Honestly, never mind. Based on your income, you probably wouldn't even get a tax deduction. So never mind. That wouldn't help you with taxes.
Yeah.
And then you're playing the long game, right? The short game is cash flow neutrality plus tax savings. The long game is I want an asset to pass down to my child that's not dependent on the stock market, right? You want an asset that you can underwrite and control physically
Yeah.
and pass that on to your child. What is your daughter's name?
Inaya.
Inaya. So you
Yeah.
want to pass that on to Inaya. Inaya. And okay. And you're obviously your Joshua Tree short-term rental is not cutting it. So you want something bigger that you
Yeah.
can do more of to make it worthwhile. And for you, actually, one asset would be way better than multiple.
Yes.
Now I understand that as well. The bigger you can get, the better it is, because you want to spend the least amount of time for the most amount of tax
Yes.
deductions. I
Correct.
think this property in Florida could work, but the concern, not to say it will be profitable, right? We haven't underwritten it, but it could work for that end goal. I like, screw, I'm gonna screen share. If the video goes down, if it gets pulled, it gets pulled. What are we gonna do? Because that doesn't work so well if we're not viewing this together. All right, cool. So let's see if we cover that bit. Let's see if that doesn't. So it's beautiful $1.2 million property in Florida. I'll tell you initial concerns,
Hmm.
Florida. And not Florida because of the state. I love Florida, but because of the fact that doing short-term rentals in Florida, there are a lot of short-term rentals in Florida.
Yeah.
A lot. And they're not nearly as profitable as they used to be. And the advantage is everyone here,
Hmm.
right? These houses can keep cutting prices, right? Because they've owned them longer and they are that much closer to the beach,
Yeah.
and they will further drive down whatever income you have. This
Right.
property is beautiful. Why is it showing beach? See, it's a little
It's definitely
misleading.
not
Yeah,
accurate.
it's this area right here that's pointing to,
Yes.
not
Correct.
here. So these guys
Correct.
have a massive competitive advantage that you can never compete with,
Right.
because it's one block, but that is the one. It's like and you guys know in Rob's community, if you're looking at like Big Bear or somewhere with a lake, the guys on the right on the water have such a massive competitive advantage, not
Yeah.
just price wise, but if there's a race to the bottom, the ones close to the water will always win because they
Yeah.
have the higher amenity, even if it's only one block. It's crazy, but it is a massive advantage. Let's see. This looks like a very turnkey, beautiful property, great location.
Yeah.
My concern is that I don't anticipate it working for any other exit besides maybe short-term rental, right?
Right.
If you want to get your short-term rental, did you run Air DNA on this at all to get the short-term rental income projections?
I did, but it's because of the price, it's still not cash flowing.
Right. I did see that they're offering owner financing, but when an
Yes.
owner finances a property like this, unless they're extremely motivated, which they probably aren't because it's brand new construction. Well, maybe they are. I don't know. We haven't called them. Have you called them?
I did not. I was planning to call them. So I found it yesterday night. It seems like they're highly motivated. The description says so. I think they listed it at an astronomical price, and they've reduced like 400, 500K already. So I think they were quite aggressive in their pricing.
It's very weird to have new construction and owner financing.
Yeah,
Most people don't own a property outright if they just built it. Usually, in my mind, that is they took out a hard money loan or a development loan to
yeah,
build the property, but they must have used all their cash to build up the property. I mean, that's kind
right.
of crazy. And it's not that people don't have wealth for that. They do. It's just not as common. Um,
Yeah,
Usually you only get owner financing once someone owns a property for a long enough time,
yeah,
or it's such a low price, This is
yeah,
one of those unique ones where, let's see. Okay, so sold. So listed for sale. So they probably demoed it and redid the whole thing is what they did.
Yes. Yeah. So they
Because if
listed for
you can,
2 million.
yeah, for 2 million, 1.6. Actually, this would be a great one too. You want me to call them or no?
Yeah. I mean, yes.
All right, we're gonna turn this live underwriting into a. All right, you guys mute yourself.
Yep.
All right. So for anyone who needs a class on how to do this, you find a deal, you find motivation. This guy already says owner financing, which is great. They literally Akash did an amazing job of identifying. I love looking at the historicals on a property. What have they shifted? They've literally gone from $2 million to 1.25. And they've tried
Right.
renting it with no luck at 7,000. So we know it doesn't even rent for up to 7,000. I want to say there's probably a reason for that 7,000. We just don't know what that is yet. But
Yep.
I wonder if that's what, but if there's no debt, I don't know. I don't know why that's 7,000 actually, because I don't know anything about rental comps in this area. I'm going to tell you now, it's obviously not worth $7,000 a month as a rental property, but let's
Yeah.
call and just try to understand what seller finance terms they might be open to. So if he's like every other real estate agent, no offense to the good ones, he's probably not going to answer. So we'll see how this goes. No offense. I love you agents. Sell me your deals, but answer your phones too. All right. I'll put it on speakerphone.
Hi, you've reached David. Please leave a message.
You saw my California area code. Let's try again. Oh yeah. If you don't call twice, you didn't call at all, right? That's the rule. You got to call at least twice. I'll probably call 3 times. Hello? Can you hear?
Hi, you've reached David. Please.
So I'm gonna text David. Please don't just call and then not follow up with a text message. They want to see that, especially if you have an iPhone. A lot of people have iPhones. They're gonna see you're a real person. Hey, David, and talk casually like I normally do. I saw your listing on or in Melbourne Beach. You don't need to go too crazy in the details. This address, well, whatever. Just talk to a normal person. Saw your listing in Melbourne Beach, and I was hoping to discuss the property with you. Please give me a call back. 805. All right, so saw your listing at this location. Please give me a call back. Oh, I can already tell you this property's not gonna work. 84.8K, it's too little income. Let's run it for the sake of running it and see what offer could make sense. Seller finance. Let's do that. That'd be fun. I have, okay, so let's do a quick intro of who I am, what I do. So my name is Michael Manaskayan. I own over 50 rentals. The majority have come through creative finance. I buy the majority of my deals through seller financing and subject to, and I raise capital for all of my deals that I buy. And honestly, I'm jealous of my private money lenders and private money partners because they get the same, if not better returns than I do with none of the work. So reach out to me if that's something you're interested in, because I don't mind doing the work. I have a YouTube channel where I go over deal analysis. Oh, I got some cool shorts. Probably looks better on your end than on my end. And then definitely make sure, oh man, you can't see me. Definitely make sure. Let's see. Instagram, boom. Let's see what comes up. Definitely make sure follow me on Instagram. And, you know, I share the kind of deals that we're closing, a lot of personal finance tips, whatever goes up, and my cute, adorable little baby. So Michael M. Nat, make sure to follow me on there. And if you want a copy of my free real estate investing calculator, just head to my website, michaelmnat.com, shop. And I've got conventional finance and creative finance free real estate investing calculators. We're going to be using my ultimate creative finance real estate investing calculator today. And then I have some more very specific to seller finance and subject to, as well as a really awesome conventional finance calculator. If you need help and you just want me to run through a deal with you, just like this one, but you want more of a one-on-one, I have 30-minute and 60-minute consultations, or you can buy my calculator and get a consultation as well, all at the same time. And yeah, here's a lot of the cool, awesome products that I use. There we go. Let's get into it. So let's get into the deal or no deal calculator. The first thing you're always going to do is, well, on your end, it's going to look something like this. I'll show you what it looks like. Anytime you need it, you're going to have this link. And it's going to look just like this. All you do is make a copy, right? Make a copy, very easy. Try to make it as easy as possible. I've had to learn. And then now we're going to title it. We're going to say Akash underscore. Cool. And we're going to skip all the nitty gritty of this. We're going to focus more on the deal itself. So, okay, David reached out and said, I'll call you back as soon as possible. Thank you for calling me. Cool. Thanks, David. Wait, David? Yeah. And when you're texting, that pro tip, when you're texting an agent, use their first name in your message because you're going to forget who it was. So you're going to want to do that. I mean, you could save their number and all that, but I always say their first name. So I remember, oh crap, that's who this was. This is David. So let's look at this and try to structure a seller finance deal. So 1.249 million. So let's just start with the deal info first. Let's assume they're going to want 10% down. They don't mention anything here.
No.
And we don't know what their motivation is. I wouldn't offer 10%. I don't want to give them $125,000 up front if I don't have to. Like for example, right now we're buying a 7-unit in Puerto Rico, 0% interest rate seller finance. The down payment is less than 5%. So it's definitely possible. You just have to know how to negotiate effectively. And if you were on my lenders list, if you wanted to be a partner or investor, you would have seen that deal. You'll be able to get phenomenal returns and actually own 30% of that asset. So reach out to me. All right. So this is saying purchase price is 1.249 million. Down payment is 124,900. There is no sub 2 loan in this scenario. Sub 2 loan is when you are taking a property, when you're purchasing a property subject to its existing mortgage. So you're buying the property, but the debt stays in place, but you are now responsible for the payments on that existing loan, as well as the total loan balance. There's no there's no subject to, there's no loan in place to take over subject to. So at least the way it's been presented. We could verify that using tools. Well, all right. Let's check this property on PropStream. Might as well. I'll just do all the fun stuff. Let's see. Hopefully I'm logged in. Otherwise, okay, that's fine. Oof. All right. Let me pause. Let me pause my sharing so I can log in. Okay. All right. So let me reshare. So resume share. Let me get rid of these controls because they're driving me crazy. All right. So we're going to look this property up on PropStream. It is not always 100% accurate, but I do love PropStream, and use the link below if you want to get a free trial on PropStream. So I will drop that for our community, and I'll have it linked up nice and ready for you. Saying estimated equity 1.34. Obviously, we know that's not right since they can't even sell it for 125. But you know, a big part of that is just how expensive loans are right now. Someone else try to come in. Okay. All right, so we're gonna go to details. I can't show you everything. Oh, I wish I could hide some of this. They do have other properties. Oh, it's owned by an LLC. Ooh, they got a lot of properties. Look at that. Maybe they did buy this property cash. All right, so, yep, cash purchase. Okay, there you go. They bought it cash. They put money into the deal. I would assume, my assumption is they're gonna want the down payment to cover their cash purchase and their cash renovation, right? They're gonna want to at least get that back outright, but they may not. They might have a ton of money and they don't care. So we'll see. Dang, it's been a long time of ownership. 2 years for a cash
Yeah.
deal. It's a slow flip, but I mean, they did the whole. They're gonna make a lot of money on this thing, theoretically. So, all right. So there is no loan. That's great. This is a great way to use PropStream. If there was a loan, you can get some information on that loan. For example, let's see. Most properties have a loan. Oh, wait, do they own this whole street? What the heck? I think that property was owned by them too. What? This is owned by them too? They own this whole freaking block is what they own.
Yeah. Wow.
That's crazy. All right. So, whatever. Let's move on from that. Let me show you that in another video. So they own it cash. So actually, it's high level. Let's look at the calculator. So in the calculator, you have your basic property information. You have your entry cost, which we'll break down in detail later. But the main thing here right now is the down payment to the seller. You have your debt information, right? In this instance, it's seller finance. Let's do what I like to start off with is setting it seller finance at 0%. So principal only. If it doesn't work at 0%, it's gonna be really hard to make it work any other way. So, you know, if it doesn't work at 0%, it's not gonna work at 5%, right? So, all right, and this is saying the monthly payment on something like this. Oh, so we got to get rid of the sub 2 monthly payment, which is right here, because there's no sub 2 loan. Just zero that out, and we zeroed out the loan that we're taking over. So this is saying the principal and interest payment for this loan at 1.124 million is $3,122. Seems low, but that's all right. Taxes and insurance we'll have to figure out. I don't want to get into the weeds of that at this exact moment. And you're going to operate as a short-term rental, so you're going to have a lot of utilities to account for. But this top section is primarily, besides this piece, the sub 2 loan, seller finance, payments, property taxes and insurance, and then if there's property mortgage insurance or HOA, this stuff holds regardless. And then this stuff is for long-term rental. For short-term rental, you just go down to short-term rental and you can do the analysis right here, including whatever costs you need to furnish the property. This is where you account for your average daily rate for your income and the occupancy percent to determine what your short-term rental income is. Akash, can you give me those numbers again? What the ADR is?
Yeah, the ADR is 391,
Okay, at what percent?
59%.
59%. Okay, so this is saying that for every day the property is rented, it rents for $391 a day. And it's rented 59% of the days of the year, basically. So then this is going to translate that into what would be the annual income, and then what is the monthly income based on that. The thing about AirDNA is it also includes all forms of revenue. So if they collect cleaning fees and this and that, that's already included in there. So that's something to definitely note, because you're not going to actually keep a lot of that because you're going to pay your cleaners. So you have to account for that somewhere. But from up above are loan payments for the seller finance, taxes, and insurance, which we need to get right numbers here.
I can give you the insurance is 833 a month.
Okay, so equals 833 times 12. I like it in annual terms, right? And then this was divided by 12. If you were to set this at 833, you'd have to, write a equation equals 12 times this value. Because right now it's just taking this divided by 12.
Yeah.
And then do you have any estimate for taxes? It's gonna be really hard to do taxes.
741 a month.
I think it'll be a lot higher than that.
Okay, I'm just taking it off Redfin.
Are you? Okay.
Yeah.
What does it say the assessed value is off Redfin?
Assessed.
Because a lot of the times insurance, see right here, the tax assessment is 674,000 for 8,889 a month. Right. So if it does assess to its full value, which is typically the sale price, you're gonna get screwed. Let's see what we got here. Let's. All right, what's this county? Let's go through that. Okay, property tax. Average property tax rate 1.14%, which is slightly lower. Okay, 1.14. So let's do that. Oh, wait, but what's the assessed value? Oh, Smart Asset is a great tool. Let's go to Florida. Our zip code. So this is a great way to estimate 32951. And it basically does a lot of this dirty work for you. And then this is 1125.
1250.
All right, there we go. 8,550. Looks like we're good.
It's 1250.
1250. Thank you. So 9,500, not too far off though.
Yeah.
There you go. Even, wait, yeah, even, yeah, wait. This is 9,500. So let's do that. There you go, 792. Cool. So we have the seller finance payment, the taxes, and the insurance. We have our short-term rental income. Oh, David's calling us back. All right, let's see what David's got to say. All right, everyone, mute yourself. Hello? Hello, David? Hello? Hello? Can you hear me?
Hi, you've reached David. Please leave a message.
Oh, David, you're just trying to call. Yeah, it's from Melbourne, Florida. I don't know anyone else from Melbourne, Florida, so it's probably David. I don't know what happened there. Let's see. All right, we'll keep underwriting because I'd like to know what numbers do and don't work. So, in a property like this, what do we say is like, I don't even know. How many bedrooms are there?
Three bed, 3 bath.
What do you guys use as a general rule of thumb to multiply by your square footage for, is it $8? No.
No,
furnishing
15 to
costs.
20.
15 to 20. All right, this is a luxury. So we're gonna say equals 20 times, what is it, 2,200 square feet roughly? Yeah, it's probably close. 44,000. And you're probably gonna do a lot on the yard as well to make it really stand out. Because if I know your guys' community, you really like to have really nice properties. So we'll stick with that for now. 20, just to get a rough idea for your entry cost. Then you have your, yep, we got the income, the daily rate, occupancy percentage, short-term rental income. Utilities, landscaping, internet. This is going to be a massive estimate right now, but you have your water, electric, gas, trash, internet, and landscaping. This is not that huge of a property actually, which is nice. It's a beautiful location, but the property is not super large, 2,100 square feet.
Yeah.
What else do you have? Half a quarter of an acre. There's grass and all that. So we can start breaking that down, but I would say it's probably like for a property like this, let's say equals 200 for water. Let's say 150. And I'm not super familiar with that part of Florida's utility rates. So, you know, if we had more time, we could dive into it, but we have 200 for water, 150 for electric and gas. Trash is gonna be like less than $50. Internet's like $100. Landscaping, okay. Plus 50, plus 100, plus that was internet. And then we have landscaping will probably cost you at least $100 a month, if not more.
Easily.
Because you're gonna do pest control, you're gonna do all this Florida. Let's put 200 because there's a big old yard.
Yeah.
Problem with Florida, you get that beautiful weather, I guess. Well, kind of beautiful, humid weather. That grass is gonna be growing year round. So you're gonna have to take care of it year round. Other expenses. So what we don't have here is your cleaning fee. So either we can
reduce the per night rate?
Yeah, we could do that. Is that what you guys normally do?
No, I mean,
Yeah, you just analyze,
I
you calculate separately.
I add like 200 cleaning fee for one time and at least four cleanings in a month.
Okay, let's do that. Under other expenses equals 4 times 200.
Yeah.
I wanted to discuss it first. Call me if you're. All right, cool. We'll have them call me maybe. All right, let's just stick with these numbers for now. Short-term rental property management, and you're gonna self-manage.
I would say that let's do 20% for next year onwards because I'm not going to manage next year
Right,
onwards.
and that's a good point because the larger the property, typically the lower the percentage. I've had as low as 15% for my biggest, best properties. So let's stick with 20 for now.
Yeah.
Your maintenance and CapEx, we can actually reduce this a bit if it's new construction, at least for the first few years. There's probably not gonna be as much to save for, but in the future, you are gonna want to account for more. Let's
Yeah.
cut that in half because it's a brand new construction. Once you're through inspection period and all that, you'll see the quality of the work. But just to decide if it's worth moving forward or not. Currently, it's saying you're losing $985 a month, right?
Yeah.
And we also don't even have all your entry costs. Right here it says 255,747. Let's go back to the entry costs. So the idea for real estate investing at the highest level is you're determining your monthly income, right? That's your cash flow. Your income, your monthly profit, which is your cash flow, which is your income minus your expenses minus your reserves. That's the key metric in real estate investing. You need to make sure your property is making more money each month than it's costing you. And what is that profit? Then you need to compare that to the amount of money you had to put into the deal to see if it justifies it. If that justifies it. So, and I even added a really cool feature now. This will adjust all of the analysis based on the exit strategy. So that will be an update coming out to everyone in the very near future, who already have the paid calculator. So we have 2.5% for agent commission. We can verify that. It usually says in the listing itself. And see, usually you go in here, facts and features. And if it was me, okay, good. No HOA, so that's good. And then buyer's agency fee and brokerage fee. Okay. So 2.5%. You're not going to be the one to, I wouldn't use an agent. Sometimes people pay the agent for the buyer and the seller on creative finance to like incentivize them to try to get the deal done. But let's analyze it at the 2.5%, which is I think already, in there. Rehab and furnishing costs, you don't need this. Well, you need like a little bit of property improvements or like cleaning and whatever. That's what that 1,000 is, because you already have in this instance the $44,000 of furnishing down here. So this is pulling into this down here. And then we have our closing costs, which we're approximating at 2% of the purchase price. For myself, I account for this admin reimbursement cost. So for example, I pay a transaction coordinator to handle my creative finance deals. Maybe the agent already has that since he's the one proposing creative finance or seller finance. I like to buy my properties under their LLCs, especially in new states. So you'd have to form an LLC. You're gonna have to cover your inspection. And then, as I mentioned, I raise money to buy all of my deals. Not because I need to, I guess I could use my own funds, but what I do with my own funds is I lend it to others. The main idea there is if there are great deals to buy, I don't want the amount of money that I have available to be the bottleneck in the ability to buy those deals. However, I always want all of my cash fully deployed. I want money invested with others all the time. So it works out really well to raise money from others as I need to for deals and then lend my money out to others to get my money working for me all the time. Because like you, Akash, yeah, I do a little bit of stock market, but I really love real estate and investing when there is an asset that is physical and I can understand and analyze that type of deal, not put it into a business in which a CEO can say something stupid and then tank the value 20% overnight. I don't like that kind of stuff. I don't like that level of risk. This is a lot less risky to me because you can do these numbers. So for me, I raised the money for some of the entry costs and all that. There is no wholesaler fee, so you're not going to worry about that cost. And I like to account for at least 3 months of the minimum expenses, which in this instance is your seller finance payment, your taxes, and your insurance. You have to pay those. So I like to account for at least 3 months of it to give me some runway as part of my entry costs. So that 201,000 here plus the 44,000 here leads us to our total entry cost of 245. So let's go into it a little deeper so you can see it.
Yeah.
We have all of our analysis. There's really not a lot. Is this him? There's really not. I don't think it's him. Give me 1 second. Hello? Stupid robots. All right. I mean, here, the question's up to you. If you get the tax benefits, is this loss of $985 a month worth the tax benefits for you?
So I think the point is the first year is fine, right? But the point is, recurring, the second year onwards, what happens?
Right. The first year, you're going to generate $419 a month.
Yeah.
And then you're going to lose potentially $985 a month.
Yeah.
If you have a 20% short-term rental manager. If you have 15%, obviously it's going to be a little bit lower of a loss.
Yeah.
And for you, it might be worth it because knowing you're savvy, you want tax benefits, you are going to do accelerated depreciation, do a cost segregation study, be able so you can deduct literally everything, every piece of furniture you bought, the whole house, every single component of it, inside and outside, except for the land, right? And you're going to accelerate that. So instead of spreading out the benefit over 27 and a half years, you're going to get those benefits accelerated to only 5 years. So you're going to take off a massive amount of taxes. So actually using this calculator, we can see what that looks like if you're interested.
Oh yeah, really? Okay.
Yeah, so this is why, this is why we use this one. This is slightly not the most up-to-date version. Like I said, in mine, you just click one little button now, and this will be updated with that. And you can just change the management here and everything will change with it. But let's do it manually so you can see how much I love using Excel. So our income here is here. Our expenses are here. Some of this stuff, that stuff. Then we have our property management, because we know this isn't going to work as a long-term rental. So I'm just going to overwrite all this stuff.
Yep.
Property management. And then we have reserves. Maintenance and CapEx. And then what we're going to do is we're going to change the entry cost here. Where's my entry cost? So instead of that, it's going to be right. I mean, I don't expect you all to do this. You don't have to. That's why I made it with a click of a button moving forward. But, I play with Excel a lot. So your entry cost is here. So you should be getting the same numbers now. 634 minus 3.1%. Same numbers because we're just doing the same math, but in a different section. So we have our deal analysis here. Our cash and cash return. This is accurate. And this needs to be the same. So I do like to analyze my deals 2 ways, which is first, what the reserves accounted for, and then without reserves accounted for.
Okay.
In this instance, I just like to see my worst case scenario theoretically is with all my reserves being used each and every month or each and every year, I have to deplete that full amount. Obviously, it could get a lot worse. You could probably spend more than your actual reserves. But you definitely can. Something goes wrong and it exceeds your reserves. That will really mess you up. But I also like to know what's my best case scenario. If I don't have to use any of my reserves, because my properties historically of 50 plus units, historically they're somewhere in the middle. It's not the worst case. It's not the best case. Somewhere in the middle. So I like to know what's my low end and what's my high end of returns that I can anticipate within reason, right? We can't guarantee anything, especially, you have a better ability to predict what the income will look like, but you cannot guarantee anything. All right, cool. So our total cash flow. Okay, so this is all going to our long-term analysis now. So we do have long-term analysis section here. We're going to want to update this income for the market rent, right? This is all the stuff that's done in the updated version. I almost want to just pull that to show you because it's faster than this, but we have that right there. And then we have our Insurance is already pulled, that's correct. Utilities and fees. Well, all we're gonna do is change this to short-term rental now, and that'll solve a lot of this issue. You're not gonna be using other people's money because you want to use your money so you can get all the benefits of everything. So it's not, you can use a private money lender, but you're already losing money. You don't want to even accelerate that loss monthly. So we have our market rent right here for the short-term rental, taxes, insurance, utilities and fees, which is pulled from the short-term rental section. Property management fee, which is currently 20% or 15% listed here. And what we're going to do here is we're going to set this to 0. So actually, let's see what this looks like year 1, and then let's see what it looks like after.
Yeah.
Your vacancy, you don't do vacancy for short-term rental because it's already in with the income. We've already accounted for that in the income. That's what the occupancy percentage is. We have our maintenance or our reserves savings. There's no sub-2 payment, but there is seller finance payment. Cash flow, annual cash flow. All right, cool. So your cash flow your first year. Oh, let's go into this property's going to appreciate. Let's go through all of it. So you have your property management, your vacancy, your maintenance. That's all pulled from elsewhere. Your entry cost, which is pulled from elsewhere. Your property value, appreciation, all that's grabbed from elsewhere. I would say 3% is very conservative for a property like this in Florida. It'll probably be higher, but let's stick with kind of the national average. Your appreciation, this is where it's going to change massively. So if you were amortizing this thing over 27.5 years, which is the standard depreciation, you would get $36,000 and $36,335 of depreciation that you can offset your income with over the next 27.5 years. For someone in the 28% tax bracket, that's essentially saving them $10,174. For you, it would actually be over 5 years, and we're not accounting for, you're going to get massive benefits that first year because all of your closing, a lot of your closing costs outside of the down payment and certain items, you can also offset that first year. So you're going to get the majority of your benefit that first year. Then you're going to get an insane amount of benefits over the next, because we're missing 1 year here. End of year 1, end of year 2, year 3. All right. All right, we'll deal with that later. All right, cool. So maybe you're not getting positive cash flow, but you are getting the appreciation. So you're losing $7,000 a month in cash flow.
Yeah.
You're gaining $37,000 of appreciation. So the bigger the property, the bigger the debt, the bigger the other benefits of real estate investing, the higher the appreciation if the property is worth more, because it's 3% of a larger amount. Obviously, if you're in a better market, you'll get more. If you're in a worse market, you'll get less. Your debt pay down. So the larger your loan, the more debt pay down you'll get if your interest rate, it depends on your interest rate and the loan amount, but theoretically, the bigger the loan amount, the more debt you pay down, and the lower the interest rate, the more debt you pay down. In this instance, it's 0%. So every payment is going directly towards the debt pay down. Your tax savings, which we accounted for, right? And tax savings are based on the property value because you're depreciating against it. And then your annual return is the combination of all these. So yes, you're losing $7,605. Most people should not invest like this. They cannot afford to invest a bunch of money and then keep losing money. But for the certain buyer, these other benefits massively outweigh the slight loss in cash flow. In my opinion, you can find properties that are cash flow positive that still get these other benefits, but they are hard, right? Because everyone's looking for cash flow positive properties. And people with high income earners are definitely looking for these other benefits as well. So now you're competing with a specific type of buyer. So even though your cash flow and cash return is negative, your total ROI is much higher because you get such other benefits because it's such an expensive property. Yeah. And in reality, this first year, you're going to be managing it yourself. So you don't have property management fees to worry about. So now your cash flow went from minus 634 to positive 419 that first year. Yeah. So you're able to cash flow $5,000, which further jacks up your benefit, right? Could that work? Potentially, but I don't think someone who just built a brand new property and bought it cash is gonna let you buy it at 10% down at 0% interest. So they might want more money down, which will, if you're putting more money down, your loan is less. So you're cash flowing more money a month, but you're putting more money into the deal. Like, so let's actually just run through that. So if so currently your down payment is 124,000, right? And your entry is 201,000 total. Actually, it's higher than that because we have our 44,000 from down below.
Correct.
And your profit each month, your cash flow is minus 634. If you were to increase this, right? Increase the cash flow or increase the down payment, you're going to lower your seller finance loan, which will then reduce your monthly expense on the seller finance loan. But you're probably putting in so much money, it's actually a worse deal, even if you're increasing your cash flow. So just because you're increasing your cash flow doesn't mean it's a better deal necessarily. So let's see, 20% down payment. So now your cash flow is minus 287, and your cash and cash return went from minus 3.1 to minus 0.9. Actually, in this instance, it is better. So that's not always the case. It just depends. That's why you have to analyze the deal to see and a big factor of that is you are self-funding the deal, right? You're not using a prime money lender. The more money it costs you to enter the property, because you'll see here on the using other people's money tab, if you were to use a prime money partner, what it would look like for them, their returns, if you were giving them 32% ownership and cash flow, doesn't make a lot of sense for you because you want all the benefits, especially the tax benefits, and there's no cash flow to give them anyway, right? And a prime money lender, the bigger this amount, and you're paying them 12% interest rate, the more you're losing each month, right? So it doesn't work. The higher your down payment, the much worse it is, typically, if you're financing it. If you are covering it yourself, it might or might not be better. It just depends on if the change in cash flow is more beneficial than the change in your entry cost. Cool. That was it wasn't very high level. We were kind of in the weeds, actually.
Yeah.
What questions do you have now? I can do like Q&A for a couple minutes. I don't think David's given us a call. I can record it later if and when he does, and I can share that with you all. But what questions do you have about this as a concept so you can apply this strategy to another property? And the big takeaway I would say is your seller finance, start it at 0% to see if it even works. Because he's going to want like 5%. So it doesn't work at 0%. Now you're going to lose, $3,000 a month because you're wasting all this money on interest. The principal pay down that you had earlier, which was 100% of your monthly payment, is now a tiny fraction. And let's actually quickly see what that looks like. So you have an amortization schedule here, right? It breaks down what your payments look like. So every month currently, $2,577, your seller finance payment, it's all going to reducing the debt itself.
Yeah.
However, as soon as you add any percent, you're going to start losing some of it to interest. And unfortunately, the way amortization works is the majority of your payment up front, the first several years, are going to be towards interest. So it's even worse for the analysis side. That's why I really love to buy only under 3, 4, 5%. And, I mentioned the 0% deal we're doing now and things like that. But so you went from paying $2,775 a month and all the going to principal to, let's say, add 5%. So now your payment is up to $5,363 a month, almost double. And $4,000 of that is going towards interest the first month. And it just continues and gets worse and worse and worse and worse.
Yeah.
It sucks. That's why I don't like interest.
Yeah.
But if the deal works with interest, cool. But that's why it's very important to start with none and see if it's even viable. Because if you can't make it work with no interest, what are you even going to negotiate on? And you can't force the income any higher. You could, if you did a deeper analysis, see what amenities would allow you to do that. I wouldn't say take that risk on a property like this. There's better properties out there. They can get you the same tax benefits, but might be able to drive more income. And you're in California, you're going to self-manage a property in Florida. I'm not saying it's not possible, but it's across the country from you. Any questions?
No, I think this is super helpful, Mike. I do have one more property. I don't want you to go through the details of that, but I just wanted to share with you. This is another one that I found in Montana. And
Montana has a lot of seller finance opportunities. I just saw that their voted the #1 most patriotic state. And you know what it means to be a patriot? Do your best to not pay taxes. And so seller financing is, very common because you can spread out the tax hit. And, if they don't have to use agents, and obviously they're using an agent in this instance, but if they don't have to use agents or waste money like that way through traditional banks and all that, they're gonna do it. So yeah, it was funny when I saw that, and it kind of made a lot of sense. Man, it's a beautiful property.
Listed it for 2.5 million and have got it down by 900K already. It has 20 acres of land and beautifully done.
Right.
But Air DNA does not support it. It's even lesser than the Florida one that we just looked at.
I would imagine so, because there's less comps, which in my
Yeah.
opinion is not good, because I like predictability. So the less things you can compare it to that are proven, the more risk you're taking. And
Yeah.
I don't like taking risks. For someone with 50+ rentals that use other people's money to buy those rentals and does a lot of creative financing, I actually don't like to take a lot of risks. That's
Right.
why, in my opinion, analyzing deals is so important. But you can only analyze a deal if you have good comparables for the income estimates and the expenses.
Right. Yeah.
And
Okay.
one thing I would also highlight, where even is this?
This was near one of the um, parks, the national parks that I was looking at.
Oh, we own in Spokane. Okay, so it's closer. Is this Glacier? No. Where's Glacier National Park? Oh, up here. Glacier's up here. So Missoula. So like the big, I guess, city next to it is Missoula. So yeah, I mean, if it didn't work before at a lower amount, it's not going to work on a higher amount with less income, right?
And that, yeah, and they've already mentioned that they want 5.75 interest.
Perfect.
Yeah.
So it definitely won't work.
Yeah.
That's why it's so important to get really, really good at underwriting and then continue underwriting, because then you can quickly filter out deals, because then you don't have to go through all this work. You're going to say, I know properties that generate less than $80,000 a month, a year in revenue, that are worth over this price at this interest rate will never work. So you want to have a lot of those in your mind as possible. And that might come
Yeah.
through practice. So you can filter out, because the thing I used to say when I teach not creative, just real estate investing in general, because I'm not just a creative finance guy. I invest all types of ways. One of my favorite ways currently in this market is creative finance, because that's what this market affords like the best deals to right now. But the idea is that 95+% of properties listed for sale are not great investments. They're just properties for sale. Our job is to filter through so much of that noise to find the ones that are actually good investments. The more you underwrite, the quicker you can get at saying, okay, I know there's no way this can be profitable. I don't need to go into a deep analysis of it. But it's still good to do with you all, so we can see what the numbers actually look like.
Yeah. Yeah. Yeah,
Anything
it's
else?
tough. It's tough because I've done a lot of underwriting over the last 1 month. And I think that's where I'm struggling to find the right property, or the right terms for the property.
Right.
Yeah. So I'm continuing, like, it's like a diamond in a rough.
Let me ask this. Is it that you're underwriting and deals are not working out with the returns that you're looking for, or is it that you don't know what terms to offer?
No, underwriting is not working out.
Right. Most properties for sale are not deals. They're just properties for sale, and they will not
Right.
work out.
Right.
Creative, cash, conventional, whatever. They just are not great investments. They're just a
Correct.
property for sale. They're
Yeah.
best for someone who wants to live in it.
Exactly. Like, I looked at a couple of properties, or more than a couple, in Scottsdale,
Mm.
couple of $1 million properties, but it's
Which is
just not.
saturated with luxury, because it's the freaking desert. They can build more of it. It's
Yes.
saturated with
Yes.
luxury short-term rentals.
Yeah. The other option that I have, Mike, I know you may have to leave, but the other option that I'm looking at is in the Bay Area. But that's what the way I'm thinking about it is, that could be my primary residence. I can move to a, larger house, bigger house, and my current house, I can do a short-term rental for this first year and then put it on long-term rental. So that's the other option that I'm thinking. So even if it doesn't work out from any exit strategy, it does not matter to me. I can easily
Right.
pay for it on by my own.
Yeah, you're in a very fortunate position because you have that option to do, because I think that could work for you. I would talk to your CPA if you can get the tax benefits and accelerate cost seg and accelerate the depreciation on an asset that you've already lived in and you have been depreciating. Most people
Yeah.
are already every year. when,
Yeah.
and even if you haven't, the IRS assumes that you are, so they've already been thinking you're depreciating over 27 and a half years. I would talk to your CPA and see if that is viable, or
Right.
if you will have to depreciate and write off like the next property. I don't know how that's gonna work when you move into it. I don't know if you can make the case that, oh, I know I just bought this as a primary residence, and now I'm doing a cost seg and accelerated depreciation because I'm a short-term rent it, but you're supposed to be living in it. So I would talk to them about both those scenarios and see if that's viable. I think that'd be a lot easier to say, hey, I'm self-managing this thing. But in my opinion, it's way easier for me to manage my properties. Well, it's actually much better for me to scale my portfolio properties that are out of state, because then I can't physically go and manage those assets. Like, even if I wanted to, I couldn't. It'd be too much of a hassle, which is great to be a real investor, right? Because if you're managing all your properties, it's tough. But I know short-term rentals afford a little bit more flexibility, because you already have cleaners and people coming in and out. There's a lot of automation for that tenant communication. So could be viable. Talk to your CPA. I don't know if you'll get all those tax benefits the same way.
And Mike, one last question on the PMP side, right? The private
Right.
money lender side. When they invest, so let's say if I want to invest, I get a depreciation benefit in any case or no?
You would if you qualify for the benefit, but if you're not qualifying for the short-term rental tax, like, we would give you 30% as an owner, and that, like, for example, well, I don't have it right now, but for the deal that we just raised the capital on, they get 30% of all of the ownership benefits and cash flow, including the depreciation. But they have to be willing to, or they have to be able to actually utilize that tax benefit. So they're not going to get the short-term rental tax loophole, because it's going to be hard to say, hey, I'm coming as a partner and I get those benefits, because obviously someone else is operating and managing it more than you, right? That's one of the
Got it.
criteria.
Got
And
it.
you nor your wife is a real estate professional. One thing I would talk to your CPA about is, how much in assets do I need to buy with one of us being a real estate professional to save more than us working now? Like, where is that break even? Because that's
Okay.
what my wife and I did. We realized, wait a minute, once I get to this amount of depreciation, it makes more sense for my wife to be a stay-at-home mom who is also managing our portfolio, right? She's my real estate professional. Those write-offs made more sense than her making active income, because the spread was like very little money that we're actually bringing in relative to just saving the amount that we're saving in taxes.
Got
Hopefully
it.
that makes sense, and your CPA should be able to help you with that.
Got it. Yeah.
Nice. I
Good
agree,
point.
Josh. It was nice. It's a win-win-win. Everyone's happy. I'm happy. Baby's happy. Wife's happy. IRS may not be happy, but we're doing it. We're following the exact tax guidelines. So,
Awesome. Okay. Thank you so much, Mike. I mean, this has been extremely helpful.
of course. And then, so we'll be doing this again next week. So whoever has another deal, come on by. But remember, you can only be part of the live underwriting. The link is only for our wealth through real estate community. So just check it out. Link below. If you're watching this on YouTube, link is below. Go into the community and ask your underwriting questions, or just start networking with other buyers, lenders, wholesalers, everyone. Bye,
Perfect.
y'all.
Bye.